Hello and welcome to the latest edition of Sharesify Talk Shares podcast. I'm welcomed as usual by my colleague Ian Conway. Hello, Ian.
Afternoon, Steve. How are you doing?
I'm doing very well. I'm sporting my Joy Division t-shirt today, so you can't see it really here, but I think get out some of our musical influences.
A bit of transmission.
Yeah, indeed it is exactly that.
Thought
Talking about transmission, there's been quite a lot of background noise on the old markets this week, hasn't there?
Oh, what a week it's been, Steve. What a week. Hard to avoid it really, but hey, good news everybody. FTSE's still above 10,000. I do get the sense though that there's a bit of change of market leadership going on. You know, if you look at the market today, for example, you've got stocks like Tesco up, Unilever, Centrica, the tobacco stocks. So I get this feeling maybe people are taking a bit of risk off the table because they fear that volatility might be rising. I don't know, just a gut feeling.
I suppose when we're talking about Donald Trump, I mean, volatility is just going to be a constant, really, isn't it? I mean, we had that massive sell-off in the US, not so much in Europe, but in the US in particular, early in the week. And then, of course, shares tended to come back, recovered most of their gains, not all, but most of their gains after he retreated from his earlier antagonistic rhetoric.
I mean, yeah, the taco trade, people are talking about it. We were talking about it just last week, weren't we?
Exactly
the taco trade.
Exactly that.
Thinking about defensive stocks, what was interesting to me, we talked already about P&G being maybe a benchmark for Unilever and Reckitt later, next month. P&G was interesting because it beat by a very small margin on earnings, tiniest margin, a couple of cents.
Yeah.
But sales were worse. Sales actually missed expectations and volumes were down in almost every division, yet the stock went up. And I find that it was actually P&G was one of the better performers yesterday on the S&P. I find that interesting, and it suggests to me that people are huddling around slightly more defensive stocks.
I suppose there's another element here as well. Is that when figures come out, it's not the only thing the market is looking at. And often it's the case that it's a secondary factor. What they're really looking for is guidance going forward. So we see that reaction, and we saw that massively with Intel overnight. Its Q4 results were pretty decent, but fundamentally the guidance towards the start of this year, 2026, was considered to be pretty soft, and that's really what investors have reacted against. So you can't always perceive the results being reported as necessarily being the reason why the share price is moving.
No, absolutely. I was going to say, that's a really important lesson for investors is don't just look at the earnings, look at what the company's saying, because expectations, particularly for US stocks for this year, are pretty high. Having said that, the stock had a huge run, didn't it? It was from just after Christmas. It was $35. It's $35, and all of a sudden, you look at it's $55. So
exactly.
I think it's indicated down 13% or $7 today, about $47.
But it will still be up about 20% just year to date. So we're talking about in 3 weeks, it would still be up around 20%. So that tells you about the risk on attitude that certain investors have been chasing. And also about, with that particular company, about how investors are really betting that it can turn itself around from 2 or 3, even 4 pretty horrible years.
Now, we've got another big week coming up next week, Steve. We've got Meta. You're going to be busy, boy.
It's going to be a busy time for me, but I think we'll all have to pitch in because we've got some of the big Mag 7 companies reporting. So Apple are reporting, Meta's reporting, Amazon's reporting, Microsoft's reporting, Tesla's reporting. I mean, it's really going to be very, very busy, and it's going to really provide some energy, either negatively or positively, for global markets in general. So I think a lot of investors will be from Monday really starting to go through their numbers. What can we expect? But they generally have been outperforming expectations over past quarters. Can they continue to do that? That's going to be the big question.
Yeah, And we've got some other sort of smaller but still significant names like Seagate and Texas Instruments as well.
Yeah, absolutely. Yeah. IBM as well, which
Yes,
is
Big Blue.
that's kind of brought a new lease of life over the last 12 months or so. Again, playing into its long legacy in databases, and of course as then therefore an AI play. So it'd be interesting to see whether their commentary and whether their results reflect that potential, or whether it starts to go a bit soggy for them. So just so much to look out for and keep your eyes on.
Yeah, and it's not just tech, because I'll be looking at the Chevron and Exxon numbers. Big Oil starts reporting. Then you've got defense stocks as well. You've got Lockheed Martin, Northrop Grumman, Boeing, all reporting next week.
I mean,
as
Boeing
well.
would be an interesting one to watch as well, because it's had aircraft issues, and there've been some air disasters and so on involving their planes. So it might be around, the investors might be just looking for saying making soothing sounds around, we've got these issues under control. Not so much about we're growing. It's about we are not expecting any more disasters.
Yeah. Here in the UK, we've got, we've said before, it's not a massive market for tech, but we will be watching Sage, because it's a FTSE 100 tech, as you said previously, probably the last FTSE 100 tech stock.
Yeah.
It's also the biggest holding in Finsbury Growth and Income, and that needs to go well for Nick Train, because his number 2 stock, Experian, had a bit of a flat report, and stock hit a 2-year low earlier this week. So
just for our listeners, one of the key metrics with Sage to look out for is its operating margin. In the past, it's been up around 28-29%, and they have had ambitions to hit over 30%. But there's been a lot of transition in the business, and now you're looking at operating margins of around 20%. I think they might be around 22% from recollection. So looking at that operating margin, I think it's been rebased lower long term. But to see what the direction of travel is with the operating margin, that's going to be a really core metric for investors, I think.
And of course, everybody's going to be listening to hear what they say about AI, because on the one hand, that fans of the stock will say AI is really good for them. Detractors of the stock will say it's really bad news for them, as they have for Experian.
Yeah. There's been a lot of negative commentary recently around the software space and about how AI might eat their lunch. And of course, you've had executives coming out from big firms like Workday and Salesforce, et cetera, and saying that's not the case. Look at this, look at that. So, it's an ongoing debate about to what extent AI has an impact. I think what we can say is AI is having an impact right across the economy. It certainly isn't just a tech thing. Yeah.
We've got, and the last few things I'll be looking for next week, we've got Cranswick, which is an old favourite of ours.
The old bangers,
The old bangers. Doc Martens, you're no stranger to a pair of dogs, Steve.
I do like a pair of Doc Martens, yeah.
You do like a pair of dogs. We've got pet care groups, CVS and Pets at Home. Now, they've been under the cosh because there's been an FCA investigation into price gouging with veterinary services. And then we've got a couple of airlines, EasyJet and Wizz Air. So be interesting, really, to take the temperature, see what they all have to say.
Yeah, absolutely. I suppose, EasyJet's to some degree a bit of a proxy for how busy the summer holiday season might be. But, they're such a big airline now. They do a lot of business travel as well. So it's not exclusively a holiday-driven business anymore. But yeah, absolutely will be worth watching. We better wrap up there, Ian. We were running out of time. If any listeners want to get involved, you know the score. Just email us in at editorial.com, editorial@sharesify.com. Any suggestions, questions? And if you're a company, a trust, a fund, and you would also like to get involved in these podcasts, you're more than welcome to. Just drop us a line on the same email address, editorial@sharesify.com, and we'll take it from there. We'll talk you through it. So that's it from me. Have a good weekend, everyone. Thank you very much for your time, Ian, and we'll catch up next week.
Always a pleasure, Steve. Have a good one.
Cheers, guys. Bye-bye.
Bye.